All right, guys, welcome back to Wealth and Travel on a Dime. Now, today I wanted to talk to you guys about the recent dip in the market and what we are doing. Okay, I have gone through now two what I call generational wealth opportunities in the market. We are in one right now. All right, this is something that everybody should be buying in on. I'm sorry, but it's the truth. Why is it that everybody wants to buy stocks when they're going up and sell them when they're going down? That makes no sense, guys. That's just bad economic policy there. So let me explain. In 2020, I literally was fielding people all over Facebook that were trying to convince me everything from that the stock market was going to zero to the government was stealing your 401ks and that people should sell their 401ks. If you don't know how taxes work, that would not be a good thing to do. But going to cash when the market goes down is just not something I would ever do. I don't care what I'm invested in. That just makes no sense. You're liquidating, you're accepting capital gains or losses. I don't care if you even want to play the game with tax loss harvesting. When you're in a pullback like this is where money is made. In 2020, I watched oil go basically to zero on the barrel because nobody was buying. It wasn't really zero, but theoretically it was zero. And you want to know what I did? I caught every dime I could get together and bought Exxon. Let me tell you what happened 2 years later. I got 100% return when you include dividends. 100% return. Now I timed that thing and I was just lucky. All right, you're not going to always have those kind of wins. But even when we were buying index funds at that time or very, very beaten up BDCs and stuff for the dividends, we were just making a fortune. And you can do it again at this time. And I want to make you understand that. So much so that we are putting our own cash out there. So when I say you should do this, I'm doing it. All right, so we just injected $45,000 into my wife and my account. All right, so our two Robinhood accounts, our two individual accounts, we injected $45,000. Now we'll make another video talking about where that money came from and why we did it and how we're working this. But I wanted to go over the assets we bought, which none of this is financial advice. This is just to show what direction we're taking our portfolio in and how we allocated the money in this current market. Because guys, we injected this money on Monday and it has just been going to the moon this week so far. Now, obviously, this video comes out Friday. It may not age well, or it might. We'll have to see. So let's get started. So one of the first assets we bought, because we were going to try to put the bulk of this money in lower yielding, like kind of calmer assets, because we already have a bunch of aggressive assets like YieldMax. So what we went ahead and did was we put $10,000 in QQQI. Now this has a very low margin maintenance at Robinhood. It is actually pretty stable. And there's been plenty of times I've watched it fall less than the actual SPY, which is the S&P 500. Now, it also has an extremely tax-efficient strategy. That's another reason why we picked it. So $10,000 to that. The next one was XDTE. Now, we put $15,000 in that, and that was more so not really any reason why it's more or less. It was just trying to lean yield. It's still pretty safe. It falls about the same as the market generally, but I think that it has some upside potential going forward. Now, the next one is kind of a weird play, but it actually is really safe because how they do it, and that's BTCI. Now, most people would not think that a Bitcoin ETF like this would be very safe, but throughout this entire market drop, it has held its value much better than many other assets. So we went ahead and put $5,000 into that between our two accounts. Now, after that, we started thinking we need a little more aggression. So I put $2,500 into AIPI. It's very tech heavy, but I think it's going to get a bounce. It'll be slow because it is a covered call fund. So it's going to keep getting capped as it goes up. But I think over the long term, once some of these tariffs get sorted out, I think it's got a lot of room to move. And a 35% yield is not bad. Now, one thing you're going to see with most of the assets we just talked about is you kind of can get a good frame of what you're going to get paid, whether it's weekly or monthly or whatever. When you get into YieldMax and stuff, it can flail from one side to another wildly. You may, get 50 cents here and 90 cents here. You never really know. So the dividends are much more variable, or distributions, whichever word you like to use. Now, next, we decided to make a play in Platy, which is PLTY from YieldMax. We went ahead and put 10 grand in there. That's 5 grand per account. And that was like our aggressive play. Now, the last one was something that Missy requested. My wife wanted another 100 shares of Misty, MSTY, from YieldMax. And that ended up costing her just around 22 something. I call it 2,500 just for round numbers. So 100 shares in there kind of put her back in line to where her account and my account are kind of even on those. They are depreciating assets, but that was like her aggressive play in her portfolio with this, putting this money in. Now, with all that, you'll notice that a lot of those names are migrating towards the safer side. Especially the QQQI play from Neos. Very safe option. All right. The only safer option I can really see if you want a pretty standard distribution every month would be like SPYI. And I'm looking at both those from also tax efficiency purposes because that does matter. Now, by putting $45,000 into Robinhood, we had another byproduct because of the way we invest. Because we buy income funds and then we use the margin against those to sell options. And what that does is create 2 income streams off one portfolio. Now, we do only sell about 40 to 60% of our portfolio. So unless the market's going to drop 45% or more, we're fine, especially as we add in these lower maintenance names. Because if you guys don't know, when you buy something like MSTY, it's got 70% maintenance. So say for every $100 you put in there, you're only getting $30 or 30% of it margin back. Whereas if you put something like QQQI at 25%, you're going to get 75% buying power on that money you put in. So it's just a way to understand how margin works. The reality is the safer the asset, the lower the margin maintenance, then the more they'll let you borrow against it. And then you only want to use about half of that. That way you always stay safe. Now, putting that 45K in, essentially between our 2 accounts gave us another, $80,000 to $100,000 worth of margin maintenance buying power. Now, obviously we're not going to use all that. But the reality is we were able to sell probably an extra $15,000 worth of options. Now, translating that down to premium for the week, it is like $200 because we were selling on very safe names. We were not being aggressive because we're in a giant dip. So if you're selling puts, then you don't want to be aggressive in this kind of market. You want to be pulled back to, the 10 delta, the 15 delta, or if you're doing it percentage-wise on Robinhood, 85, 90% out. That way you are very safe and the odds of you getting assigned are very slim. Now, the increased margin maintenance will of course make us make more money, but I went through and kind of tried to figure out what the lowest amount we could make on these in their current, shape based on that 45K injection. So as far as distributions, I think the minimum we'll get will be about $1,200 the way it sits now. It probably will actually be much more than that, but these are depreciating assets, some of them. So I always want to give room for it to go way, way lower and pay way, way less. But then on the other side, you've got probably $800 to $1,000 more a month we're going to make in selling options based upon having more buying power because of margin maintenance. Now, speaking about margin maintenance, we're also, like I said, selling on lower margin maintenance plays, all right? Things like the cruise lines, things like the airlines, things that have lower margin maintenance rather than like triple leverage things. It just keeps us safer and also makes it so we can sell more options when you really get down to it. We may be making slightly less than the people selling on those volatile names, but we avoid that volatility and we're able to sell more options. So I won't say we're making as much as people selling those names, but we're making plenty. Now, Going forward, we really have to understand the fact that we're getting to the point where we're making so much money, we have to start thinking about tax efficiency. Up to this point, there kind of is a line where I'm like, okay, this is return of capital, this is this, and you start figuring it out. And with all the other money we make, it wasn't a big deal. But now we have kind of gotten to the point where I don't have to worry about, like, we're already over what the ACA healthcare would subsidize. So that's no longer a real thing. I mean, we don't get a subsidy because we make too much. So we just pay for our health insurance. It just is what it is. But taxes, once you jump up from where we are now to the next step, they go up a lot. So you have to think about tax efficiency going forward. Are you willing to accept, say, a 14% yield that basically you'll pay no taxes on for the next 10 years, 12 years? Or do you want to have something that's got a much higher yield and 20 to 30% of that becomes return of capital? So you don't have to pay taxes on that little bit. It's really a number you have to work out for yourself and how it comes out on your taxes. Because these are short-term capital gains for the most part. So you're going to be taxed way higher. So if you can build up 14% that comes out basically tax-free, that goes to the bottom. So you have less capital gains on the overall, which brings your tax bracket down. It's kind of one of those things you have to sit down and run your own numbers, especially with see how many income sources you have. But once you start as a couple running up to about 150, 170 a year, it's time to start looking at taxes. And I mean, maybe you're just like, I don't care about taxes. Let's go. And more power to you. I'm just looking at the long term because we have accounts that are going to unlock in 7 to 8 years with retirement money that we can access. And I want to make sure that I'll be able to have this portfolio going and yank even more cash out of that to put in long-term capital gains to build up even more income for us to spend every year. So just thought we'd make this video, share that we are putting money in this generational wealth building opportunity that we have in front of us. So many people are crying about the market. I'm sorry. If you're a retiree living off this and you have no money to put in and you're just trying to pull some out and it's down, I do apologize. I understand that you're in a different situation. But for all of us that are trying to invest and build wealth, this is a gift. This is the time to get in and pick up more shares, build up whatever you're doing. It also has a lot of volatility. So a lot of these names that are safer are paying a little bit more when you're selling options on them. So you need to take advantage of that while you can. This video may come out and we may have a bigger dip, and that's okay. I didn't miss my buying opportunity. I got in at all the names at great prices compared to the last year at what they've been at. So I'm happy where I got in at. If it goes down more, it goes down more. It's not an issue for us. We are in this for the long term. We're building wealth every single day in multiple ways. And you should subscribe if you want to see more about that. And also see how we're taking and working hard and playing hard. Because we got some upcoming trips you guys are going to want to check out. So with that said, I will see you in the next one.